Okay, welcome to another Sacred Account Saturday. It's good to see everyone today. My name is Jerry Fetta. I'm the owner, founder, and CEO of Wealth Dynamics. And I'm coming to you today, every Saturday, to talk about the Sacred Account. Okay. And I'm talking about it because I want to go over it from the standpoint of, buy term, invest the difference, which is what I actually started in the financial industry with, versus what I teach now, which is using life insurance as a tool to build wealth and build passive income and do a lot of different stuff, right? Now, before we dive into things today, I do want to welcome everybody. So if you're watching, the first thing that I want to make sure that we're covering, whether you're on Facebook, whether you're on Zoom, is having a purpose for being here, right? What's your reason for being here? Like, why are you here? Why are you watching? Do you have a sacred account? You want to learn more about this? You want to make sure you understand it? If so, that's awesome. That's one of the reasons we do these courses. If you're not a client of mine, what's the purpose of being here? Is it to consume content and get free information and then head on your way? Or is it to become a client, work with us, and get financial help with your goals and dreams, right? Or are you trying to learn how does life insurance work? Maybe this is a brand new, you don't know who I am, you don't know who the company is, and you're like, what is this, right? Either way, you want to have a reason for being here. It's impossible to learn something. It's impossible to learn something and to succeed with it without knowing why you're learning it. Okay. Whoever had this problem in school, like a perfect example and illustration. Anyone else bored during high school, during middle school? Right? I was, right? The reason why is I didn't know why I was there. I didn't know why I was there. I didn't know why I was learning the things I was learning. I didn't know why I needed to know geometry. I still don't know why I needed to know geometry. I don't use that one. But I didn't know why I was learning about the inside of frogs' bodies. Like, it was just like this random stuff that I had no purpose for and no reason for being there. So I was like, why am I here? I was a straight A student all the way through till about 10th grade. And I realized, man, if I keep getting A's, they're going to keep giving me tests and putting me in more classes. I'm just going to go get some C's from now on. Right? Like I'm going to just do the bare minimum, make sure I don't get expelled or fail or whatever. And then I'm going to focus on the things that I actually, care about, the things that matter to me. Right? So similar with this, most people are with finances the way that I was with school. Like, think about it. They're like disinterested. It's not something you're excited to learn about. It's like, oh man, here's the money talk again. Or, it's an area of problem. It's an area of confusion. And it's because that purpose is missing. Why do I need to know about it? Okay. Now I'm going to connect the dot here. If you are on this webinar, you have some kind of way to have a Zoom and a computer or iPhone, which means that you have income and bills, which means involuntarily you are part of the financial system. You are part of having to earn a paycheck. You are part of having expenses. You are part of needing to know how that works, right? Imagine like, you're born and you never learn that you're supposed to eat. Like no one ever teaches you that, they're just like, you got to do these things. You're going to figure them out as you get older though. Right. And they teach you how to walk and they teach you how to get dressed, and no one ever teaches you how to prepare food and eat it. Right. It's kind of an exaggerated example, but eating, I actually interact with food less frequently than I interact with my money. Right. When I drive, that costs money. When I've got the lights on, that costs money. I live here, that costs money. The food that I'm going to eat costs money. So why would I not know how money works? I know how food works. I know how oxygen works. I know how bathing works. I know how, working works. But what about the thing I'm working for? The paycheck. I get that. And there's no training. There's nothing. And so, that's a big thing I want to start with today is the purpose. Pick that out. The second thing is understand that this can be learned. Okay. This is not unlearnable information. Okay. This is not reserved for the fat cats on Wall Street, for the banking elite. This is not reserved for the 1%ers only. I'm not a 1%er by nature, guys. I was born in Big Lake, Alaska. 62 kids in my graduating class. I did not go to college. I was a C student in high school, right? My parents got divorced. And so I was a pizza delivery guy at one point. Like that was my job for a number of years. There's no reason why I should know this stuff that I know. And the reason why I know it is because I decided that it mattered and I decided that it could be learned, right? And the reason I decided that it could be learned is I realized it's just math and vocabulary. At the time, I didn't even have an iPhone. So it was like, okay, it's just math. I can count on my fingers. I can do math in my head. I can sketch it out. I can get a calculator. Vocabulary, I can get a dictionary. Now, if I want to know something, it's right here. If I want to know the math behind a financial transaction, right? I pull up my calculator and boom, I can go figure out the math behind the financial transaction right on the spot. If I want to know what a word means, I pick up my dictionary.com app and boom, I look up the definition of the word, and right on the spot, I now have instant knowledge on what it means. We're in a time and place where nobody has a reason not to learn about money, right? So if I can understand the math, if I can understand the vocabulary, I can understand money. Now, the second thing is we have to get rid of the idea that we know it all. Okay. The idea that we know it all already, like there's a pinnacle of knowledge and we've reached it, right? And a lot of times I know it all is actually code for I've heard this before and I don't apply it. And because I don't apply it, I don't like hearing it again because it reminds me that I don't apply what I'm hearing. The people that complain, oh, I've heard this before, I know this, good. Where are the results at? There's no results. Like there's not knowledge. Like you got to have results to have knowledge. And so for me, when I'm learning something, I come from a place of, okay, there's always more to learn. I can always improve. I can always grow. Even as an investor, I've been learning recently, right? Like you have to learn, you have to continue growing. You got to look at things that are happening, be like, okay, cool. There's a lesson there. There's always a way to improve, right? So that's the second thing is if I have that mindset, I can learn, I'm willing to, I don't know it all. I've got a purpose. It's going to be very easy. And then the next thing is I want you to be focused on how you're going to apply what you learned today. Okay, my rule was if I didn't apply information within 24 hours of learning it, it basically is like I shouldn't have learned it at all. Like, what was the point? In my world, my viewpoint and reality was that the information will actually physically disappear from my brain if I don't use it within 24 hours. Okay, I want you to think with that. Like, I want to give you permission to take that mindset from me and apply that to your own life. Even if it's not true, it works. Right? Like it works. Like, so I'm going to use that. I'm going to learn this and then 24 hours or less, I'm going to apply it. Otherwise it's gone forever. I'm never going to have it back. Okay. So those are the things I want to hit. Now, the next thing before we get started, two things that I want to cover. First, if you are not yet a client, my goal is for you to become one today. Right. And the way that you can start is with a copy of my book, Blueprint to Financial Freedom. Okay. So this is my book, Blueprint to Financial Freedom. I'm going to go ahead and put the link here so you can go and grab this. This is jerryfetta.com/B2F promo. You can get a free copy of the book. The book is not only full of a wealth of information, like actual, here's what the top 1% do, here's how it works, here's when you do it, here's the sequence that you do it in. Not only does it have that kind of information, but it also comes with a free course supervisor. Who's ever read a book and had trouble getting through it? I have. Right? So we have someone on staff full-time. Their job is to reach out to you and make sure that they answer your questions and help you get through the book. Okay. The average American reads less than one book a year because they don't finish the one that they actually pick up. Right? The average, Fortune 500 CEO, they say that they read about 60 books a year. So you got to finish 60 books. Right? So these are places that we want to help out on. So with the book, you also get a free coaching call. Okay, so you're going to see in the chat, in the comments today during the webinar, during the training, there's going to be two people that are going to reach out to you at various times. We have Rodrigo Torres. Rod works on my team. He is a phenomenal person to have in your life as far as helping you get through the blueprint, answering your questions. We also have Nano Aquino. Nano has worked with us for about 4.5 years now. And so he's going to be reaching out to you in the chat as well. With the intention of getting you on a call and answering your questions, making sure that you've got the book, you understand it, you can apply the information. Guys, that's totally free, right? Like, so the book is free. You pay your shipping. I think it's like $10, $8, $10, something like that. And then with that, you're getting a supervisor, you're getting someone that's making sure you finish it. Like, we're taking responsibility for you actually having read the book, right? Name one other time you had an author that did that. And then we're also taking responsibility for you being able to apply what's being learned. That's why we have you connecting with Nano. It's why we have you connecting with Rod, because we want you to actually be able to apply the information. Okay. So without further ado, I want to dive into our topic today. And that topic is buy term, invest the difference, or term insurance, right? Versus using the sacred account, using whole life insurance. Okay. And so the first thing to know here is, again, what is the purpose? So I want to share my backstory a little bit on this. I grew up in the financial industry over a decade ago. 18 years old, I got my life insurance license. I worked for a large national firm. I started, training, going on appointments, helping people with finances, building my own agency, building my own team. And I was taught that when you are, an individual, and I'm going to go ahead and sketch this out, you have this thing that was called the theory of decreasing responsibility. right? And it looks like this. It's you have in the early years, and then we have in the later years. Okay. And so here it's like in the early years, you have on the low end, on the low end, you have low savings, right? When you're a young person, your savings, your income is lower, right? Your assets are lower. But what do you have? You have high risk, right? Why? Because you have debt, you have kids, you have a spouse that might depend on your income, and these are all risks. These are things that, you better have some money, you better be saving, you better be taking care of things, right? And then basically what this says is as time goes on, those things go away, right? Hopefully you pay off your debt. Hopefully your kids are grown up, they move out of the house, right? What did I just write here? Spouse. Okay, I thought that said spark. Sometimes I can't read my own writing. So hopefully all of these things have gone down. You no longer have them. And then hopefully you've been earning, saving, investing. And so you do have savings, income, and assets, right? So the idea was that you would want to have insurance up until this point, right? Because, when you pay off your debt, you have the kids move out, you've got the income, you've got the assets. If you die, nobody's dependent on these risks. These are going to be taken care of. And also, you die in theory, you've got savings, income, and assets, all this stuff happening later on down the road. Okay. And so the idea was that you don't need to have these things insured anymore at this point in time because you're what's known as self-insured, right? Now, here's the problem. This all looks really good. Like I did this for probably 4 or 5 years. This was what I believed. This is what I taught. And on paper, it looks really, really good. And on sometimes in real life, it also works well too. So this is not something I'm going to tell you, hey, this is a bad idea. It doesn't work. But I'm going to go ahead and poke some holes in it. How many people do you know that their kids moved out, but the family still has debt? They still have student loans. They still have a mortgage, right? Their spouse and them still need to both work in order to support the household expenses. Okay, that's virtually everyone, right? How many people do you know that are 30, 40, 50, 60 years old where they don't have enough savings, right? They still are paycheck to paycheck. They don't have enough in assets. They're not going to be able to retire. And if they do, they're not going to stay in retirement. Okay, so here's the problem is this works as long as these things happen. Right. So this idea of I'm gonna insure because I need it now, but in the future I'm gonna be self-insured. What if I'm not? Right. Some statistics: 60% of America has less than $1,000 in savings. The average retiree will run out of money within 10 years of retirement. The average retirement account balance is only $70,000. 8 out of 10 Americans live paycheck to paycheck. Okay. So this is the statistics behind, okay, what's actually happening. So we don't have a situation of, okay, we built up our savings and we've got our assets and we've got this and we don't need insurance anymore. So here's the problem and here's the solution. The insurance is not the solution. Like having term life insurance does not fix that I paid off my debt. Having term life insurance does not fix the fact that I'm not saving money. Having term life insurance does not fix the fact that I'm not investing. Right? Like that doesn't handle those things. A solution handles things. So when someone says, I have a solution for your problem, to me, that means I'm thirsty and I drink this and I'm no longer going to be thirsty. So when I look at the problem and I'm like, okay, you don't have income high enough, you're not saving, you're not investing, you've got a bunch of debt. And I'm like, oh, here's the solution, term life insurance. None of those things got fixed. Right? Like it's all still happening. Now I just have an added expense so that if I kick the bucket, my family's not going to be stuck as bad, but it didn't fix anything. Right? So here's the idea behind what's supposed to happen is that you're supposed to save and invest money, right? So here's what I used to teach people. I would say, okay, you have to excuse my message pop up at the bottom there. It's my team getting some work done today. So I would tell people, okay, so you are spending over here, right? So you've got expenses. Okay. You also over here, you have income. And over here, you have debt. And over here, you have assets. right? And so I would show people, like, obviously you need to have income. If you don't have income, none of this works, right? You want to keep your expenses down as low as you can. You want to pay off all of your debt, and you want to take as much of the difference here between your income and expenses. You want to take as much of that as you can and put it into assets, right? Now, this is not complicated, but most people don't do it. And so I would tell people, for life insurance, you only need term, right? Now, what is term insurance? Term insurance is temporary coverage. It's like car insurance. I only have it for the period of time I pay for it. It can expire. Like, for example, if I get a 20-year term insurance policy, after 20 years, my insurance goes away, right? For the 20 years I have it, I have coverage, right? If I were to die within the next 20 years, it would pay out. Okay. And this coverage would cover things like it would pay off my debt. It would cover some expenses. It would replace my income, right? It would cover the fact that I lack assets, right? But it doesn't do this. Like, having term insurance does not make me save more money. And here's how I know this, because you could apply the same concept with anything. Okay. So if I am going to buy a phone, I could say iPhones are expensive, buy an LG and invest the difference. Okay. If I was going to buy groceries, I could say the same thing. Organic groceries are expensive, so go to Walmart and invest the difference, right? Like, I can tell anyone, buy something that's cheaper and then take the extra money and go put it into assets. Like, that's not any sort of financial ingenuity. It's like, okay, yeah, if I spend less money on if I buy, crappy bacon instead of great bacon, I have extra money and I could go invest the extra money. The question is, do we actually do the investing? And then where do we actually invest? And for how long? And do we keep the money? Does it grow? And all these different things come up. And so what most people end up doing usually is nothing, but the ones that use this term insurance concept, they'll have their term insurance over here. And then over here, they give all of their money to Wall Street and banks. Right? Buy term and invest the difference with who? Wall Street and banks. Right? Like, this is not investing. This is retail financial consumerism. Investing means I buy an asset. Like, so for example, we work with a company called Equity and Help. When you invest with Equity and Help, you actually buy a home. You don't put it with Wall Street. You don't put it with the bank. You don't stick it in a fund. Like, you actually physically buy a home, and that's your home, and you're going to have someone that lives there. Equity and Help is going to manage the whole thing and do all of the property management and make sure the finances are going well, but that's your home. You control it, right? So here's the problem: is spending $30 a month on insurance instead of $100 a month on insurance, for example, isn't really helping me buy a home. Right? Like, this is the equivalent of me saying, go buy unleaded gas instead of premium. You'll save 15 bucks at the tank. You could put that towards buying a home. Like, sure, of course, like, all right, but not really. Like, it's going to take me a long time for that to help me in any way, shape, or form. Right? So this was the term insurance concept. What is term insurance good for? Because it's not good for nothing. It does have a reason. It is there. So the things that you want to look at with term insurance is, do I need it just for death benefit coverage? And is it for just a specific period? And is it really, that's the only thing I'm trying to solve? I want really cheap life insurance. I don't mind paying for it. It's not going to ever pay me back. I'm not ever going to break even on it. And I just want to pay out of pocket for that. Right? Now, here's what I would look at, like with the sacred account, with the whole life insurance instead. Okay, so with term insurance, I might pay on it for 20 years. And every month I pay that premium. And I do that for 20 years, right? And so this money is a total cost. So like, let's say that I have, a term insurance policy that is, $100 a month, which is pretty realistic for most people, $100 a month. And I do that for 20 years. Over 20 years, I have spent $24,000 on life insurance. Okay, I will never recoup this. That's a total cost. It doesn't ever pay me back. It's just like buying gas. Like, I used it, right? Except with the gas, I actually did use it. With the term insurance, only about a 2% chance that you'll die and need it. like during the time you have the coverage, right? Why would that be? Because again, back to that first slide I showed you, in the earlier years, you've got risks and you have less assets. Okay, well, between the ages of 20 and 40, I'm not going to die. Like there's a 2% chance. And this is not 2% chance I'm going to die. I'm saying this is 2% chance of those that actually die during the period of coverage on their term insurance policy. Right? This is the actual number. So the insurance companies love this. Okay, 98% profit. So that means that they're pulling in money that they don't have to pay back. There's no obligation. They get to keep that. Right? Now with whole life insurance, if you design it correctly with the sacred account, check this out. So with the sacred account, our minimum is $250 a month. Right? So you're going to put in $250 a month, and basically, let's do the same. Let's say year 1 to year 20, and every month you're paying into it. Okay, now what's the main difference here? Of this 250, 70 to 90% of this is immediately available in your cash value. And this 250 grows at a 3 to 5% rate on average every year for the life of the policy. Okay, so let's do the math on this one. We put in $250 a month. We did this for 12 months a year for 20 years. And we contributed $60,000, right? You're like, wow, that's a lot more money. Like you put in 60,000 versus 24, right? So $60,000 spent. But check this out. Because this is actually growing, this $250 a month is growing at a 3 to 5% rate for the next 20 years. In 20 years, I have, this would approximately be 91 grand. Okay, over here, I spent 24,000 and I have 0. Like total costs, didn't get any savings, didn't grow for me, none of that, right? Here, I spent 60, I have 91. Now, the other thing that I want to look at here is usually by about year 7, this is what's called my break even. Right, what that means is that if I, at the 7-year marker, I'm doing $250 a month times 12 months. I do this for 7 years. I've put in 21K. And I also have in my cash value, 21K. So let's just like really simplify this. If I put in 21 grand by year 7, and by year 7, I have 21 grand, how much did my insurance cost? 0. Like I have the insurance, it's still there, but I have all of the money that I put back into it. It's available to me. It paid for itself, right? That's why we call this the break-even period. Now at 20 years, I put in 60 and I have 91, right? So then again, how much did my insurance cost? Well, my insurance in 20 years costed me nothing. It actually gave me $31,000. I costed it, like it, you see what I'm saying? It gave me more money that I put into it. Now, here's the beautiful thing about this is this entire time, I can take loans against my cash value. So if I have $21,000 here in my cash value growing at 3 to 5%, I can actually borrow against that. My cost to borrow is going to be about 1 to 3% in interest cost, but my 21 grand still keeps growing at 3 to 5%. I can take this 21 grand out and I can invest it. And also still make the 3 to 5 like the money never left. And also I still have a death benefit. And also I still have benefits to be able to pull out money for terminal illnesses, critical illness, chronic illness, whatever it might be that I need, you name it, it's all still there. So I do this in year 7, and in year 20, I'm still going to have 91 grand, like the 21,000 never left, plus whatever I made on this investment. Like, can you see the difference here? I can't do this with term insurance. If I could, I would use it, right? So it's not even that this is bad. It's the equivalent of saying, I want to drive, I want to drive on a racetrack at 100 miles an hour. Well, I'm going to need 2 things. I'm going to need a racetrack and I'm going to need a fast car. Okay, if I don't have a racetrack and a fast car, I can't do that. If you give me, like a little, Toyota or Fiat or Prius or whatever, and you put me on a dirt road somewhere out in like the middle of nowhere, I can't go 100 miles an hour because the car is not capable and the environment's not capable of it. Okay, so this is like that. I can't go 100 miles an hour with this. Will I have death benefit? Sure. Is it cheap? Sure. I mean, cheap relative to what you think cheap is this year I spent 24,000 and got nothing. Here I put in 60 and got 90. I think that the 24,000 total expense is not cheap. Right? But this is a thing that you want to look at is, okay, I'm looking at life insurance. If I do the term thing. Now, let's say that I do invest the difference, right? So let's just talk about investing for a second. Well, first, let's look at how much are we going to invest, right? So we're over here. We've got our invest the difference. Over here, we have our sacred account. Right? So most people, when they invest the difference with term, what are they doing? They're usually buying mutual funds. Right? That means they're putting it with Wall Street. The average return, and this is not my statistic, this is from Dalbar, they're a mutual fund rating agency. The average mutual fund investor over the last 20 years makes about 3.88% after fees, but before taxes and before inflation. Right? Now, this is like the average. Let's say that you're really good and you can get 8% over the long haul annually. I'm not saying what did you get last year. I'm saying over the long haul, if you look at 20 years of investing. I mean, let's look at the market right now. Let's look at the S&P 500 and we'll pretend like we're going to get that number. Okay, so the S&P 500 over the last 20 years did an annualized return of, this would have been since 2002, did an annualized return of 7.5%. Which is pretty close to what I said, and that's with dividends not reinvested. If we reinvest dividends for the last 20 years, the annualized return was 9.57%. This is in the stock market. This is in the S&P. This literally, and this is before fees, right? So if you have fees, let's say with your average mutual fund fees, you've got annual fees, you've got 12B1 fees, you've got cash drag, you've got, also there's the, account fees, quarterly fees. So these fees on a mutual fund account, generally, it cuts it about in half. So even on this 9.57, you're probably looking closer to like 4 to 5%. Because there's so many different fees and things in there. Like you only see the one fee when they pitch this to you, they're like, yeah, we just charge 1% a year. If you dig deep in the prospectus, you're going to see that there's mutual fund turnover, which is taxes. Every time the fund manager sells something, you're going to pay the taxes for the sale that they did. It wasn't up to you. You could actually get taxed in the mutual fund for investors that owned it before you ever did, right? There's also cash drag. Like they have to keep a certain amount in cash reserves and liquidity that reduces your return. There's typically there's going to be account annual fees. There's going to be management fees. There's going to be 12B1 fees. Right. So usually you're going to see about half of this, which means we're probably only netting about 4 to 5%. Right. But let's pretend that none of that's true. Let's pretend that none of that's true. And we're still going to make the entirety of the stock market minus just a 1.5% annual fee. So we're making, like I said, about 8 after fees. Right. So we buy term, we invest the difference. Right. So we put $1 in. And let me just clean this up a little bit for you guys. We put $1 in this mutual funds. And we are going to get 8% on that $1. That's it. Okay. With the sacred account, we put $1 in. We're getting 3 to 5%. So let's just deal in certainties. Let's just call this 4. So we put $1 in, we're getting 4% on that $1. We can borrow against it at a cost of 2%, which means here we're making a positive 2% spread. We can take the money we've borrowed. We can go invest this in real estate that's paying us a cap rate of maybe 12 to 14%. Right? So we have $1 growing at 4%. And then again, let's get rid of the uncertainties here. Let's just call this one 13. We'll split it down the middle. Right? So we have $1 that's growing at 4%. And also at the same time, we're making 13% on that same $1. We are paying a cost of interest of 2%. So we've got a 2% spread. 13 plus 2 is 15. All right. So I only went to Houston High School, not a college, none of this stuff. But I know for a fact 15 is more than 8. So when I ask myself, do I want to buy term life insurance and put the difference in a mutual fund where I earn 8%, which really is about 4? Or do I want to put it in the sacred account where on this dollar in total, I'm making 15%? That's a no-brainer. And it's not even about the life insurance. Like I couldn't give a crap about the life insurance. Like if I want life insurance, I'll go buy life insurance. I'm not going to think about it and have all these different technical arguments. I'm looking at return on investment. Okay. You show me, and this is also this number here. What does this include? This includes cost of insurance. This is another one to bring up. This includes my insurance costs. This is net of all of this. Here we said what? 20, was it 21,000? Yeah, $21,000 that we paid for insurance costs that have not been factored into this return. So I still have to factor that in. That is an expense. We're comparing apples to apples. With the sacred account, we say it's 3 to 5% because really it's higher. And after insurance costs, that's what you net. So we just tell you what you net because those are going to be included costs. We've already included them here. So here we need to account for them as well. So 15% net, 8% net of mutual fund fees, but not net of your insurance costs. So I don't know, depending on how much money you put in, what that brings you down to. Maybe that brings you down to 7.9. I don't know. Maybe it brings you down to 6, but it still brings you down further than 8. Right? So this is a big deal, something I wanted to point out because, this is not, it's not talked about. I was a licensed financial advisor teaching this stuff. I owned term. I was putting my money in mutual funds, and never once on the exam did I learn about this. Never once on my trainings with my management team and stuff did I learn about this, right? So that's something that I had to figure out on my own. And when I figured it out, I was like, wow, the math on this actually doesn't make any sense. Okay, now we did it easy. We did it on Zoom. Before, I did it on a notepad. Okay, literally, I went page by page, number by number, and it took me 3 or 4 hours to do. And I did all the math every single year, line by line, all the way down. And I actually saw this does not make mathematical sense. Okay, if it did, it would show up in the numbers. Numbers don't lie. And I was looking at the numbers. I'm like, okay, this is not buy term invest the difference. Sounds really nice because what does it do? It caters to spend less money. Right? Spend less money. The largest insurance marketing corporation in the world, they've got over 100,000 agents, strictly and only sell term life insurance. Why? Because the company makes that much profit. 98% profit margin on having to actually pay it out. Okay, the other difference on a whole life policy, and guys, be sure to ask your questions in the chat really quickly. I do want to take a pit stop and answer some questions actually. Second thing was also, if you got reached out to by Rod or Nano, message them back. Okay, reach out to them in the chat. They want to set up a call with you. If you haven't gotten a copy of my book yet, let me pull this up really quick. Okay, Blueprint to Financial Freedom. Right. This is, again, go to jerryfetta.com, jerryfetta.com/B2F. And you can, B2F promo, and you can get a free copy of this book. Okay. And that's going to include a supervisor that gets you through it. That's going to also include a coaching call with Rod or with Nano. And then it's going to include a lot of life-changing information with finances. We've had several people that have read the book and said, I can't put it down. We had a guy, I just got a communication from someone on my team last week. He read the book and said, I want to quit my job and do this full time. Like I want to teach this to people. Like this is how impacted he was by the information in the book. Now, I'm not saying you should buy it so you can read it and quit your job. Okay. Nano will even attest. I told Nano when he wanted to come work for me, I was like, don't, like, just keep your job, dude. Like stay in Texas, keep your job. So that's not the goal. The goal is for you to get the book and learn, implement, apply. We wrote it in a way where you can do all of it yourself. You don't even need us if you don't want to, but if you want help, we're here to help as well. Okay. So really quickly, if you did get a message from Rod or from Nano, reach out to them in the chat and get a call set up. All right, so let's just check with our questions here. So Lawrence Roybal says, very grateful to be associated with Jerry Fetta and with Wealth Dynamics. Thank you for another important session. You're very welcome. It's good to see you here. And I don't see a ton of questions just because this is not something I think a lot of you guys are doing. I don't think a lot of us do term insurance or wonder about this. So Rod says the other thing to love about the sacred account is it forces you to save money. Most Americans spend what comes in and even find themselves stuck in debt their entire life. This forces savings, and you can pay off debt with the account. You can become a bank, borrow against it. Your growth on the account's also tax-free. Yeah, and that's a good point. Back to the very beginning of what's the actual problem. We talked about this theory of decreasing responsibility. You have debt, you have this, you have that. Well, the solution is something that helps you solve those things. So the sacred account can help me pay off my debt. Term life insurance can't. Okay, the sacred account can help me build assets. Term life insurance can't. Right? The sacred account can help me invest. Term life insurance can't. Like if I don't, I'm still having to go do those things and solve those problems. Right? So that's going to be something to definitely consider. And then the other thing Rod mentioned is that the return on the sacred account, the annual return, it's also tax-free. Right? With the mutual funds, that 8% that I showed you, that's not tax-free. You're going to pay taxes on it. Right? And so that basically gets you in a position of, okay, I've got 8%, I'm going to pay taxes on it now. Talk about inflation as well, right? I paid taxes. Now inflation this year was 9%. I didn't make anything. And I still had my insurance costs, right? So that's the problem with that type of system. And again, not that it's bad. Financial products are amoral, and they're also inanimate objects. So they're not bad, they're not good. They don't make decisions like that. We can't judge them on a scale of bad and good. We can judge them on a scale of useful and unuseful. And so for me, that's very unuseful, right? Like I have a net negative return on my investments. It's with Wall Street, a bunch of crooks. I've got insurance costs that never recoup themselves. That's unuseful for my purpose and for what I'm using it for. And I actually had someone email me the other day as a life insurance agent. And he was basically saying, look, I don't like what you teach. Like, I disagree with it. Here's all the reasons why. And it came down to, okay, well, you do a very different thing than I do. We're not going for the same outcome. We don't have the same purpose. So based on that, of course you don't like what I like. It's kind of like for me, if I were to go to a doctor versus a naturopath, I'm very into organic and natural. So if I go to a doctor and they're like, yep, the solution for all of your bodily ails is either pills or surgery, right? And when you do the surgery, you're going to need the pills. So you might as well get both right now. Like, I don't like that. That doesn't meet what I need. Now, does that mean that's bad? It's up to someone else to decide, right? Like, that's not my choice on whether that's a bad person or a bad system. I go to a naturopath doctor and they say, okay, I'm gonna give you vitamins and herbs and dietary changes. Are you exercising? Are you getting enough water? Is there anything going on that we can assist you with that actually we can change, because symptoms are usually evidence of something else. I like that. That's helpful to me, right? So I look at the naturopath and I'm not going to say he's good and the doctor's bad, but I'm going to look at the doctor and say, yeah, that doesn't help me. That's not useful for me. I have no purpose for that, right? So that's kind of the way that I look at this. So I want to go ahead and dive into another aspect of this. I did see a few more questions come in. All right, so Henry has a question. Let me bring Henry on live really quick. Again, if you guys are in the chat on Zoom, we will bring you on live and mic up so I can talk with you for a little bit today. Let's see if we can bring Henry on. All right, I just gave Henry mic permission. Let's see if we can chat with Henry and answer his question here. All right, I don't think so. So let me go ahead and read his question. He says, how soon are funds available to invest elsewhere, or do you need to wait 7 years? Really good question. So the funds are available immediately, right? And the best way to tell you this is probably just to show you. So let me find an actual illustration sample we can go through here. All right, good. So we're going to look at an actual illustration to answer Henry's question, just to give everyone a little bit of a visual. Here we go. So the funds are available immediately and the money still keeps growing while you use them. So let me share my screen. And I'm going to zoom this in just so it's a little bit less confusing. Otherwise, it can tend to look a little bit confusing. And then we're going to bring this in a little bit, move this over. Good. So this is showing someone putting $1,625 a month for 20 years. That's $19,500 a year. Case in point, that's like what your 401k would be. So if you did this instead of the 401k. So if I put in $19,500 or $1,625 a month, in the very first year, I would have 15 of that available. The 19.5 is still growing at 3 to 5% long-term on an annual basis, right? So now on this, if I put in the first month, for example, let's say I open my policy tomorrow and I fund it with $1,625. I'm going to have probably about $1,300 available tomorrow that I can borrow against. My 1,625 that I put in still keeps growing at 3 to 5%. Right. So, and then this just shows year by year because I'm continuing to put money into it. So like if I'm trying to do a real estate deal, for example, by about the 3-year marker, I would have enough to do a real estate deal. Right. And then I would still have all of this money. It's still growing at that 3 to 5% rate. Okay. So that is what that looks like and how quickly you can borrow. The answer is right away, but I wanted to give that visual just because seeing it is always easier. I do see some more questions in the chat. We have a question. Is there an age limit? I'm 71. So it is life insurance. So to answer this question, you probably will not get the best internal rate of return if you're 71 years old. However, you can open it and have someone else be the insured. So if you have kids, grandkid, business partners, spouse, somebody that is related to you or connected to you and younger and healthier, you can have them be the person that's insured because that's cheaper. You can still be the owner and still fund it yourself. But basically that gives you that cheaper cost. Okay, we have a question here from Haru. Let me see if we can bring Haru on live here. All right, we're live with Haru. How are you today?
I'm doing great, Jerry. How you doing?
Hey, I'm doing good. It's good to talk to you.
Indeed, likewise. I wanted to know, like, I literally just got a whole life insurance policy with USAA, so I wanted to know what was the difference between me doing that and doing the Sacred account.
Good question. So without seeing the actual policy, it is going to be hard to tell, right? So we won't actually see the illustration. If I were to make an educated guess, I would tell you it probably looks something like this. You probably have, so you've got your death benefits. You've also got your premium, the money going into it, right? And then you have your cash value. Okay, so you probably have something where you're paying maybe $50 to $200 a month. Generally speaking, this is all going towards death benefit. And your cash value is probably $0 for the first 1 to 3 years. Right, this is how most life insurance policies are designed. As far as your break even, this probably, and again, I'm making an educated guess, this probably is going to happen in the next 15 to 20 years where you have more in cash value than you actually put in, right? And you probably on this, you might have like maybe 100,000 to 200,000 in actual death benefit, right? So this is how most agents design whole life insurance policies. Again, it's not bad. It just doesn't serve my purpose. If I want to be able to borrow against it right away, I need to have 70 to 90% in my cash value in year 1, right? Not 0. I need to have, ability to break even, by year, usually 5 to 7. Okay. Not years 15 to 20. I need to have a minimal death benefit and I want to be able to put in as much money as I want to put in. Usually I can put in about 15% of my income. Maybe a little bit more if I squeeze things through my MEC limit. So Haru, if you want us to check it out, you can send your illustration or your policy to Nano or to Rod, and they definitely can take a look at that for you and just find out what it looks like and what's going on there. All right, a couple more questions here. So we have a question from Tom. Let me see if we can bring Tom on here and answer his question. All right, we are live with Tom. How are you doing today, Tom?
I'm doing well. How are you?
Hey, I'm good. What is your question?
So what I wrote in there, I'm brand new pretty much to all of this and fairly illiterate when it comes to wealth and investments. And I already talked to Neno and signed up with Wealth Dynamics and everything. I'm excited to get started. But one thing that I wasn't sure about when you were talking about the amount that you're saving over the course of 20 years in the sacred account, the first step that I'm doing is eliminating any debt that I have. And so I was wondering, when you take that money out to eliminate debt, are you paying like a second payment, or is that going to affect the amount of money you're putting in over that course of that 20 years?
Excellent question. So you'll have the best way to think about this, Tom, is front end and back end. So front end is called a contribution. Back end is called a loan repayment. So if I contribute, let's say $500 a month on the front end, that's going to go in my cash value. It's going to give me money I can now borrow against. It's going to keep growing, all the things we've talked about. Now I build that up and I borrow against it. And let's say I pay off a Visa credit card, right? That minimum payment that I used to make to Visa, now freed up, I have that money back in my life, and I'm going to make a back end payment. I'm going to do a loan repayment and pay back my sacred account now. And so it's not going to change my contribution. My front end is still my front end. All of that's good. Now, in addition to that, I'm doing a loan repayment through the back ends. That's a good practical question. I like that one. Let's see here. So we have a question on, can you talk about the organization above that backs the product? Who are they? How old? American? How strong? What reserves, etc. Yeah, so we work with companies like Guardian Life Insurance, Mass Mutual, New York Life. These are companies that have been around for 150 to 170 years. They are American companies. They're not publicly traded, so they're privately held. They're owned by the policyholders. So if you have a sacred account, if you have a life insurance policy with Guardian, you are an owner in Guardian Life Insurance Company. That's why you get dividends, is you're getting shares of their profit. As far as their financial strength, just to give you an idea, last time I looked, and this is just New York Life Insurance as an example, their total assets are larger than the total assets of the country of Kuwait, which means if they wanted to buy Kuwait, they could. Another good example, Mass Mutual Life Insurance, they have over $20 billion in cash reserves. Not investments, not assets, like cash reserves, like just money sitting in cash. Now, cash reserves don't even cover the policy death benefit payouts. That's a separate set of reserves that they actually have, and they consider those to be a liability because they have to pay them on a policy. And this was one more good reminder on this. This was one more thing I wanted to cover. On a whole life policy versus a term policy. Okay, so in a term policy, let's look at the relationship here. If I have years 1 through 20, and I have a 2% chance of using the policy, what is the insurance company hoping happens? They're hoping that they collect money from me for 20 years and then I don't die and they never have to pay out. Can you see, like, that's the business model? Collect money for 20 years every month and then not have to pay out a death benefit, right? With a whole life, this goes from age 1 to 121. And at 121, it does something called endow. Endow means that they're going to pay me the death benefit, even if I'm still alive at that point. So on a whole life policy, the company goes into it knowing there is a 100% chance they will pay me a death benefit. That's why it's called whole life insurance. So they're not thinking, let's try and get as much money out of him and hope he doesn't die and we never have to pay him. They're saying, no. If he never dies, even if he lives till 121 years old, he's still going to get the entire death benefit from us. So think about the difference in business model there. They have to make sure that that money is there because it's guaranteed that it's going to pay out at some point in time. And there's no way around that. So they're building up more reserves. They're more solvent. They're having to be more considerate of the fact that that is a liability on their books. They're going to have that expense. I will die someday and that money will get paid out, right? Versus, let's hope we don't have to, right? Let's hope we don't have to. Let's collect as much as we can. And let's keep it at 20 years and let's make as much money as we can make off of them and hope we don't have to give them anything, right? So I share that just because that is the difference in business model. It's kind of like if I had a customer and I knew they were never going to come back, right? My customer service might not be as great. But if I know they're going to come back and they're going to come back and they're going to come back, then I need to make sure I treat them well because I want them to keep coming back. And so with term, they know I'm never going to come back. I'm going to buy the policy. I'm going to pay for it for 20 years. If I never die, they'll never talk to me again. Hopefully I don't cancel. With whole life, I'm going to come back to take policy loans. I'm going to come back to put more money in. I'm going to come back with referrals. I'm going to come back, because at some point I will die. I'm going to come back for many different reasons. And so they need to make sure that they're set up for that, right? So that's a really good question there. Let's see here. Any other questions? Dano says a symptom is evidence of something else. Debt is a symptom. Lack of savings is the root issue. Yeah, that's a great point, guys. So when you're trying to knock out debt, if you don't start first by saving money, you're just going to end up right back in debt because life will happen again, just like it did last time. You'll end up borrowing money because you didn't have the money there in the first place. So you fix that by creating money and savings first. Dan says the Kuwait anecdote puts it in perspective. Awesome. Yeah, that's always a funny one. Good. Let me just check on Facebook and see if we have any other questions there too. Good. Let me just check on. All right, good. I don't see anything on Facebook. So really quickly, guys, I do want to get things kind of wrapped up. We're coming to an end here. The purpose of today's course is this is like strict financial literacy. If you're a client, like probably most of your friends and family don't know this, right? Like if you're friends with like adults who are responsible, they have things like mortgages and life insurance and 401k plans. They're not doing the things we talked about though. Okay, what are they doing? They're giving the money to, an insurance company that's going to keep 98% of it. Hopefully never has to pay them out. That's the mindset. They're giving the money to banks. We know what banks do. They're giving money to Wall Street. We know what Wall Street does. And they're giving money to the IRS. We know what the IRS does. Like those are not like, those shouldn't be the top 3 people we're giving our money to, right? It's like giving your money to the mafia. Like they're not helping you. Like they're extorting you for everything they have because they're that big and they can't. So as far as like, if you're a client, this is good knowledge for you to have. You probably already have a sacred account, but this is something you can share with others. Having that conversation with them about their finances and making sure that they know this is an option, right? Like for me, when I learned about this, it was like a moral thing. I was like, I can't not share this with people. I wrote a freaking book about it. Like that's how important it was for me to make sure that people know that this is an option, because if I have the cure for cancer, for example, I'm not going to be like, oh yeah, I'm just going to keep it to myself, right? I'm going to share it. Second thing is, if you're not a client, let's say you have term insurance or you've been thinking about the sacred account or you're interested in it. Again, guys, grab a copy of my book. Go to jerryfetta.com/B2F promo. I'll pull the book up one more time. Okay, again, this is going to be jerryfetta.com/B2F promo. And you can grab a copy of the book. It's going to be free. You cover your shipping. It does cover with a course supervisor. It comes with a coaching call as well. And again, guys, if you have not connected with Nano, I want to just drive this point home. Get on the phone with Nano, get on the phone with Rod, connect with them, do an appointment, do a coaching call, get the book, become a client, get your sacred account. Okay. Like this is the best time to start, right? This is not something I want to think about it. I want to wait. What's going to happen if you wait? If you have credit cards, you're going to pay more interest if you wait. If you're putting money with Wall Street right now, you're going to pay more in fees if you wait. Right? Like the only thing you would wait on is you don't know if this works, like you don't understand it, or you don't have plans to use it, right? No matter how good it is, I'm not going to do it because I don't have any intention of improving my finances. So as long as I know this makes sense and I know it works and I know that I'm going to personally use it, then I would do this. I would get set up with the book and I would at least get started on the education so that you can start getting this implemented in your own life. Okay, so again, that's jerryfetta.com/B2F promo. I am going to go ahead and wrap it up here. Oh, it looks like we have maybe a couple more questions. Mark asks IULs. No, we don't use IULs. IUL does not work with the infinite banking concept. We don't have enough time to dive into that today, but we do have other content and other material on that. Okay, we have one more question here. If you are putting a large amount of money each month, does 30% have to go in to buy higher life insurance? So typically the more money you put in, the more you're going to have available. Right now, buying the life insurance is not a bad thing. The life insurance is actually why you get dividends. That's the unit of ownership that you have. So money that goes into cash goes into cash. A portion of that is going to go towards buying the actual death benefit, the life insurance. That is where the dividends come from. So if I don't buy that, I don't get any dividends, and none of this doesn't work. Right? I'm just putting money in cash with no income. So you do always have a split. You do have, if you're putting in more money, you are going to have more money available. Less of it goes to insurance costs, less of it goes to death benefit, more of it does go to cash, but you do want to have that balance of both. So again, for us, we want to see, 70 to 90% of that money available in cash value right away. And then the other thing too is, that 3 to 5% return is calculated on your contribution, not on your cash value. So really inclusive of buying death benefit, that's already baked into the numbers. Like we already know what the returns are, even though we factor in those costs. Okay, one more question here. What about using an existing universal life policy? So we definitely could check that out. So, okay, if you want to get in contact with Nano or with Rod, they can look at that existing universal life policy. I would still say probably the insurance side might be cheaper if we put the coverage on someone else, but you can actually transfer that universal life policy over to another one. And you could put that money into a sacred account instead. So, okay, it looks like Nano just messaged you. Check your chat and just send Nano your cell, and you guys can get connected for a call there. Let me see if we have any other questions. Great questions today, guys. I love these. Awesome. I think that's it. So I am going to go ahead and wrap up for today. We will be back again next Saturday, 1 p.m. I want to encourage you, invite someone, bring someone if you can, a person that you would like to get just educated on finances, learning the same stuff you're learning, right? We do have a call with Nano Aquino. That's going to be Monday, 4 p.m. Eastern time. I believe Nano's still going through Liar's Poker. And so we talked about Wall Street today. That's going to be a great overview of what is Wall Street doing with the money when we give it to them. They're often committing fraud. They're paying themselves high profits and fees and all this different stuff. So that's a great place to go learn about, okay, what's it look like in the kitchen, right? Because it's got some interesting things happening. Otherwise, thank you for watching. Be sure that you share this, connect up with Rod, connect up with Nano, grab the book, and I will see you guys next week.